Okay, boys and girls, let's talk about the markets. I know some people are pissing their pants because the market's been dropping like a knife. And it looks like it's going to break and go below that low that we made on 17 June. And people are saying, you said we're not going to go below that, you liar. Okay, let's see what's happening, right? So yeah, I did say that I believe that the low we made on the 17th of June was the low of the bear market, that it was unlikely, very unlikely we're going to go below that. And the reason is because since 1957, since the beginning of the S&P 500, every time there's been a bear market and the market dropped more than 20%, and after that 20% drop, whenever the market was able to retrace 50% of the drawdown, as you can see, we dropped from there all the way to there, and the market retraced more than 50% of that drawdown every time it happened in history. Since 1957, it never made a new low again. So I said it's very unlikely we're going to make a new low, because if we do, then, well, it's going to be something new in history, right? So could we break that low? Well, I keep saying to people, my students, that anything can happen in the markets. Anything can happen. So even something improbable is possible, right? That's why we call it a probability, not a certainty. Now, the Dow Jones on Friday already made a new low. So the S&P 500 could well follow Dow Jones and retest that low on 17th of June as well. So what the hell happened? Why did the market suddenly plunge like that? Okay, so it's because of the 21st of September, Jerome Big Mouth Powell. The Fed did something that the market did not expect, and neither did I. Now, the Fed raised interest rates by 0.75% to the target range of 3% to 3.25%. Now, that everyone expected, but they did something else. They said, you know what? We're going to raise interest rates even more aggressively. We're going to kill everyone. No, they didn't say that, but basically that's what they were going to do, right? So the Fed projected to raise interest rates now up to 4.25% by the end of this year. That's another 125 basis points for the next two Fed meetings. And that was way beyond what everyone expected, because everyone expected the Fed to raise to like 3.5% and call it a day, right? But no, they're going to raise to 4.25% by the end of 2022 and raise it to 4.6% by the end of 2023. Now, that caught me by surprise. I did not expect that. Why? Because I said that once inflation peaks, the market will bottom and the Fed can pause. Now, has inflation peaked? I believe so. If you take a look at all the leading indicators of inflation, all the drivers of inflation, it's been going down. The 5-year inflation break-even rate has been going down. All prices have been collapsing. All's in a bear market. Commodity prices have been going down. Housing prices have been going down. Everything is going down. What else is not going down? The only thing not going down yet are wages, because the job market is still very tight. There are a lot more job vacancies than job seekers. And so what perplexes me is kind of like the Fed, based on what they've done, they're kind of like, spraying the cockroach. And the cockroach is like, inflation is like dying, right? But they say it's not enough. We want to make sure the cockroach is dead, so they're taking a hammer and smashing that cockroach. So I think that it's overdone. I think that the Fed is over tightening, but who am I to advise the Fed, right? But that's what it did, okay? And so the market panicked, and initially the market went up, but the market collapsed. Now, in addition, Fed Powell, he said the word pain 7 times in his speech. He was worse than Clubber Lang in Rocky III. And he also said that, you know what? We're going to do whatever it takes to kill inflation. And if the economy dies, it dies. Like Ivan Drago in Rocky IV. Okay? So basically the Fed, what he was saying was that, you know what? We're going to force a recession. Now, he didn't actually say that, but if you read between the lines, that's what he meant. And so when the market is, oh my God, recession, oh, we're going to die. And so the market is now pricing in a recessionary bear market. And that's why the market has been bloody going down. So that's the bad news. There's a very high chance we are going into a recession, already in a recession. Now, here's the good news. Let me say, is there good news? Yes, there is. Remember Kung Fu Panda, what Master Ukui said, in life there's no good news, there's no bad news, there's just news. Well, the point is this, for every bad news, there's always a corresponding good news. What's the good news? The good news is this, because of what the Fed did, it has created panic selling. It has caused what we call liquidation, a liquidation event where the market has dropped in a parabolic fashion, 90 degrees, right? It's like, oh my God. So this creates panic selling. It creates false liquidation. And this is what we call capitulation. And this usually creates a market bottom. Now, it may not be the bottom, but it is a bottom. If you take a look at all the indicators, for example, look at the fear and greed index, we are at extreme fear. If you take a look at the put call ratio, it's extremely bearish. If you take a look, any sentiment indicator is extreme bearish right now. Now, I've got an indicator that kind of like measures extreme oversold levels in the market. It is over here, my Oversold Spx Indicator, and it works on weekly candles. And I've shown this before historically, right? Now take a look at this one over here. Now every time you can see that it drops below the lower range, which is minus 80, okay? It has marked a market bottom, right? Marked a market bottom, marked a market bottom. But ideally, this must also happen with the normalized ATR above 80, right? So this marked that first bottom, as you can see there. Can you see it went below that? Now, we just went below minus 80 again, which means we are now marking another bottom right here. Again, I repeat, it may not be the bottom, but it is a bottom. So what's my point? My point is that based on these very extreme bearish readings, the market is really oversold. And I expect that we're going to get, let me just go back to these. Okay, I expect that we may or may not test that low, right? We may not go below that. I don't know, right? I can't predict it. Or we may go below that, right? Which again would make history, right? But the point is this, even if we do go below that, and it may force this bottom here, and that could likely lead to a very strong rally that would fit in very well to the rally to the end of the year, right? So we know that based on seasonality, the market will rally strongly at the end of the year, especially during the US midterm elections, the last 2 months, right? So yes, I do expect a very strong rally up there. Now, some people at this point of time are saying, but Adam, you just said the Fed is going to force a recession. You're saying that we could be in a recession. So how the hell can the market go up when we're in a recession? Because remember something, that the stock market is not the economy. The stock market is a leading indicator of the economy. The stock market moves ahead of the economy by 6 to 9 months. In other words, the economy can be going into recession, can be in a full recession, and the market can be going up. So in case you're a bit confused, let me explain with this chart over here. Now, you can see the blue line represents the economy. So the economy is going up, right? Early recovery, full recovery, early recession, and full recession. So this blue line represents the economy measured by GDP. The red line that you see is the stock market, which is represented by stock prices. So the stock market goes up, makes a market top, market goes down, and there's a bear market, late bear market, and market bottoms. And again, notice something interesting. The stock market, which is in red, and the economy, which is in blue, they do not move together. The stock market moves first, and then the economy follows, because the stock market is always pricing in the future by 6 to 9 months. Now, the question is, are we right now in a recession? I'm curious. Leave your comments in the comment section. Do you think we're in a recession right now? Or do you think we're not yet in a recession and we're going into recession? Now, my feeling is that we are already in an early part of a recession. Now, the only organization that can call a recession is the NBER, the National Bureau of Economic Research. The first 2 quarters of this year was already negative. So we're already in a technical recession, but not an official recession. The NBER needs to call an official recession. Now, here's the problem. By the time they call an official recession, it is usually 7.8 months after the recession has already started. So check this out. According to the NBER, the business cycle peaks are announced an average of 7.8 months after their dating. And business cycle troughs, which are the bottom, are announced an average of 15.8 months after their dating. So what does that mean? So again, what that means is that by the time they announce that it's a recession, it's already 7.8 months after the recession started. Talk about a late indicator, right? Now, how long does an average recession last? Check this out. In post-World War II, from 1945 to 2020, the average recession lasts 10 months. So think about it. By the time they call a recession, it's already 7 months late, and the recession lasts for 10 months. So by the time they call a recession, the recession is over. Duh. Okay? Now, what's the point? The point is this. We can't wait for them to call a recession because it'll be over by then, right? We have to kind of like look at some of the leading indicators. And I think the leading indicators show with, again, oil prices collapsing, commodities collapsing, housing going down, we are in a freaking early recession. Okay? Now, is that good or bad? That's good. Why? Check out this chart. Can you see that when the economy, which is the one in blue, when the economy is in an early recession, where's the stock market? The stock market is in a late bear market. In other words, we are already towards the tail end of the bear market. We are nearer the bottom than we are at the top. Many people think that if a recession is here, we should sell stocks. That's the most stupid thing you can do, because when a recession is here, that's when you want to be buying stocks, because again, the bear market is towards the tail end. We're towards the end of the bear market, right? And some people think that, hey, I will only buy stocks when the economy recovers. Now, check this out. By the time the economy recovers, right, early recovery, and you buy stocks, you're buying stocks near the market top. You're freaking too late. In fact, you can see that when the economy is in a full recession, the bull market is already halfway up. So, don't look at the economy to decide whether to buy or sell stocks. Look at where the market is right now. Now, again, check it out. When does the market bottom? The market bottoms when there's panic selling, when there's capitulation. And the market tends to bottom between early recession and full recession, between these two. Now, the current price to earnings ratio of the S&P 500 as of the 23rd of September, we are right now at 18.66 times earnings. So is this considered cheap or expensive? Is the market overvalued or undervalued? Well, if you take a look at the last 10 years, the average PE ratio has been 26 times earnings. Okay, so currently we are 18 times earnings, which is we are one standard deviation below the 10-year average. So based on the PE ratio, the market looks undervalued. Now, I've heard some comments recently that, but Adam, if you take a look at the Fed funds rate, which is the interest rate set by the Federal Reserve, it's gone up a lot, right? It's going up to like 4% Fed funds rate. The 10-year Treasury yield is going to 4% or 5%. So when yields are so high, the PE ratio of the S&P has to go down. Is that true? Now again, be careful what people tell you. You always have to do your own research to find out for yourself. And that's what I love to do. When I hear people say that, I say, okay, let me do my research and let's see whether that's true. So what I did was I went back to history and I said, okay, when was the last time the 10-year yield? So this is the 10-year yield right now, the one in magenta, and currently it's at 3.69%. You can see the 10-year yield has gone up tremendously in the last 12 months, right? And it's approaching 4%. When was the last time the 10-year yield was at 4%? Over here. So I've drawn this line at a 4% mark. So it happened over here. This was back 2007, 2008. And of course, it was way above 4% over here. Here, the 10-year yield went all the way to 7% from 1999 to 2000. It went up to 6, 7, 8% over here from 1994 to 1998. So these were the periods when the 10-year yield was at 4, 5, 6, 8%, way higher than where we are today. If you look at the Fed funds rate, we are right now at 3.25%. When was it above 4%? Again, it happened over here. It happened over here. It happened over here. So during those times, what was the PE ratio of the S&P 500? Was it way below where we are now at 18 times earnings? Well, not really, right? So you can see from 2007 to 2008, the PE ratio was from 16.8 times to 18.4 times. From 1999 to 2000, the PE ratio was at 30 times to 32 times. So in other words, the PE ratio of the S&P can be really high even when the 10-year yield and the Fed funds rate is way above 4%. Okay, look at this. The PE was from 15 times earnings to 27 times earnings when the 10-year yield and the Fed funds rate were at 5 to 6%. So it's not true that the PE ratio of the S&P has to go lower when interest rates rise higher. It is simply not true. So if we are in a recessionary bear market right now, how low can we expect the PE ratio to go on the S&P 500? Well, let's look at the last 3 recessions and the last 3 bear markets. So over here, you can see that what's shaded in gray is the recession, right? So recession over there, recession over here, recession over here. And if you look at the bear market period, the first one was from March 2000, where the bear market started, to October 2002, where the bear market bottomed. So what was the lowest PE recorded during that bear market? It was 26.1 times earnings right there. That was the lowest PE for this dot-com crash bear market. Now, some of you are saying, but Adam, the PE ratio went all the way down here. Went all the way down here. Why don't you look at that one? Because that was not a bear market. That was not a recession. You can see when the PE ratio went all the way there, that was back in 1995 to 1996. No bear market, no recession. We're looking at bear markets and recessions only. The next bear market and recession was from October 07 to March 2009. This was during the great financial crisis. And the lowest PE recorded during this bear market was 20.68 times, which is roughly about October, right over there. Okay. Now again, some of you be wondering, hey, why don't you take this lower one, right? Because this one happened in 2006. 2006, no bear market, no recession, right? So we're looking at bear markets and recessions. Now some of you are wondering, hey, does this chart look right? Why is the PE ratio shooting up to 124 times? Yeah, that's what happened. Why? Because remember that PE ratio is the share price, the market price of the companies, divided by the earnings per share of the companies. So what happened during the financial crisis was that companies, especially financial companies like Citigroup and JP Morgan and Bank of America, their profits dropped by 90%. Okay, so what happened when the earnings collapse? When the E drops, the PE goes up. And that's why you had this insane PE jump during that period. Okay, so there's nothing wrong with the chart, right? This is the actual chart. Okay, now the last bear market and recession was the pandemic. This was Feb 2020 to March 2020, and the lowest PE recorded during that bear market was right here, right at that bottom of there, which was 16.83 times earnings. So what's the point of doing this? The point of doing this is this. If you take a look at the last 3 bear markets, the lowest PE that was reached was 16.83 times, which was the last bear market. So currently we're at 18.66 times. And if you're thinking, okay, so Adam, if we drop to 16.83 times, where does it put the S&P 500? What level should we look at? What's the downside target? So to answer that question, we have to do this calculation. Remember that the level of the S&P 500 is based on the earnings per share of the S&P multiplied by the PE ratio which we are using. So what is the earnings per share of the S&P for the full year 2022. Now, so far, companies have reported the first 2 quarters. We've got 2 quarters more to go. So what are the projections? Well, if you look at the consensus analyst projections for 2022, they are projecting that by the end of the year, the earnings per share will be $225.34. That's the expected earnings per share of the S&P 500. Now, if you look at Yardeni Research, which is what I follow, they are more pessimistic. They say, no. We project an earnings per share of only $215 by the end of 2022. So I'm going to take the more conservative 215, right? So you can see I've got 215, 215, 215. Next, I multiply 215 by the PE ratio. So what PE ratio do I take? Well, first I take 26 times PE. Why? Because 26 times is the average of the last 10 years. That's the average PE. So that is kind of like if the PE goes back to the 10-year average, that will put the S&P 500 at 5590. Now, if you look at 5590, it's all the way up there. And right now the S&P is at 3693. So to get all the way up there, yeah, you got to be a bit on drugs to think that's going to happen. So I don't think that's going to happen, right? But that shows you that if the PE can expand back to 26 times, then the S&P should be there. But I don't think that's going to happen. Now, what if the PE ratio remains where it is right now? We are right now at 18.66 times earnings. And we multiply it by $215 earnings per share estimate for the full year 2022. That gives us the S&P 500 to be at 4,012, which is above the current level. So we could rally to 4,012 based on this number. And what's the so-called the worst case scenario based on this? The worst case would be to multiply 215 by 16.83 times. Again, how do we get that? That was the lowest PE during the last few bear markets. So that would put the S&P at 3618. So if you take a look at the charts, you can see that 4012 is right there and 3618 is right over here. So that's why I'm saying that I won't be surprised that by the end of the year, we should at least rally back to that level. At least back to 4012. And of course, if things turn out better than expected, if corporate earnings exceed expectations, they continue growing despite what the Fed is doing, then we could rally all the way, even higher. And of course, 5,005 is that ultimate limit, which I don't think we're going to reach anytime soon, but anything is possible. Like I said, anything can happen in the markets. But what's the downside? Again, based on that projection, the downside is 3616, which is just below that low on the 17th of June. So like I said, even if we go back down and we retest that low, I don't think it's really likely that we're going to go a lot lower than that. We could go down, force that low, take out the weak hands, and then, rally back by the end of the year. So currently, that's my base case scenario. Now, some people have brought up an interesting point. They said, but Adam, this current bear market, the S&P 500, is only down 24%. Whereas if you look at all the other past bear markets with recessions, if you take an average, they were down 34.6%. So we've got a lot more downside, don't you think? Now, so far, we are 9 months into this bear market. And sure, of course, it's possible that the S&P could go a lot lower. But then again, a lot of the big companies are already down more than 30%. And not small companies, big companies like Amazon, like Nvidia, they're down more than 30%. If you look at this S&P 500 heat map, you can see that outside of energy, outside of healthcare, and outside of utilities, for the other sectors, a lot of the big companies are down more than 30%. Check that out. Amazon's down 31%. And it's not a small company, it's a huge company, down 31%. Alphabet down 31.45%. Meta, Facebook down 58%. Check this out. Nvidia down 57%. We've got Microsoft, which is a king. Mr. Softy, the king, down 29%. You've got JP Morgan down 31%. What else have you got? You have got a lot more. You've got Bank of America down like 28.68%. So these are large. Home Depot down 34%. These are big companies. So if you are holding some of these companies and they are down like 30, 40%, and you're thinking, my God, if the S&P goes down even lower, then my companies are going to go down even more. Well, I doubt that's going to happen. So my belief is that even if the S&P drops another 10, 15%, that drop will not come from the companies that already dropped. It will come from the companies that have not dropped yet, right? Like energy. So to me, if the S&P drops a lot more, that drop will come mainly from the energy sector, because energy tends to underperform in a recessionary environment. When I studied past bear markets, what I found is that the majority of great companies that you hold, if they are fundamentally good companies, they will in fact bottom way earlier than the actual S&P 500, especially if the companies drop more than the S&P. They tend to bottom a lot earlier than the S&P 500. So in other words, even if the S&P keeps going down, that company that you own, that stock that you own that's gone down a lot, it could actually start going up a lot earlier. So let me give you an example. Take a look at during this financial crisis where the market bottomed in March of 2009. This was a great financial crisis. And I'm going to show you a few of the stocks that I own in my portfolio. Not at the time, but right now looking back, right? So for example, if you take a look, let me put in a Yum Brands. So you can see that Yum Brands did not bottom in March when the S&P bottomed. It actually bottomed somewhere in November 2008. So it actually bottomed about 4 months before the actual market. And you can see that it declined 26%, which was not as much as the S&P declining 55% during that financial crisis. Here's another example. Look at MasterCard. So again, you can see that MasterCard actually bottomed somewhere here, right? Which was earlier than the S&P 500. It bottomed about 2 months before the S&P bottom, and it only declined like 11% during that 55% drop. So again, market drops 55%, but if you hold great companies, it would not drop as much. And if it has dropped more, initially it will tend to start its own bull market a lot earlier. How about Amazon? So you can see that Amazon actually dropped even more than the market. And remember that back then, Amazon was not as profitable as it is today. But Amazon bottomed again in November 2008. It bottomed about more than 4 months before the market actually bottomed. And when the market kept going down, you can see that Amazon already started its bull market a lot earlier. And I suspect that's what's going to happen to a lot of the tech companies that got whacked early on this year. That they will start to recover way before the actual S&P. Look at Alphabet. Again, Alphabet bottomed here in November, way before the S&P bottomed in March of the following year. McDonald's, right? You can see McDonald's bottomed. My God, it bottomed here, right? It bottomed here when the S&P bottomed here. So it kind of like bottomed 1 year before the S&P 500. Thermo Fisher is another one. Okay, so Thermo Fisher bottomed in December before the S&P bottomed as well. So again, there are many examples of this. So here's the point. Again, we can look at charts, we can look at macro data, we can have a probability of where we think the market may go. But at the end of the day, I tell all my students that all this is purely for entertainment because it doesn't affect my investment decisions. No matter what the market does, whether the market bottoms this month or next year, I don't really care. Because as long as I'm holding great companies that are generating higher profits and cash flow over time, and I've got a portfolio of all these great companies, they're going to grow in value. And even if their share price drops temporarily down, now you can either choose to ignore the share price drop, take advantage of it by adding a greater stake in good companies, but don't get psychologically affected by these drops. Because remember, if you're holding good companies, these market drops are purely temporary. They mean nothing. All right. When I buy shares in a business, my intention is to only sell them in 3 to 5 to 10 years. So wherever the price goes in the short term, I don't really care. The only thing I do is I take advantage of it by adding more shares. And again, if we are in a recession, remember the most stupid thing you can ever do is to sell. The smartest thing you can do is to hold and build your position, because in time it's gonna build your wealth. And I'll see you guys at the top. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.